I'll get started while she's getting on. We're energy finance partners. Samina and I have been partners in this business for about 10 years. And I'm not going to get too in the weeds on our backgrounds, but both of us share lots of time spent at large investment institutions in New York, and paroled ourselves from that, if you will, about a decade and a half ago to start Energy Finance Partners, with a focus on deconstructing traditional upstream oil and gas private equity business. She does have a good library. We really wanted to partner with best-in-class operating teams that had, prior to our founding, Energy Finance Partners been working with the big blind pool private equity firms like InCap, Riverstone, et cetera. They were looking for a more direct investment partnership with family offices, multifamily offices, and we felt like we could provide that with best-in-class legal, administrative, tax, et cetera. And we can talk some more about that as well. We had a successful first transaction prior to COVID. We'd identified an opportunity in buying minerals in the Permian and partnered with an operating team to execute that. And that let us develop our strategy and structure, as well as start and develop if you will, additional business in the software upstream oil and gas analytics called Lower 48. Again, I'll let Samina talk a little bit about that as she starts to present. We are very excited about what we're doing today with something we had identified prior to COVID, in that we wanted to go out and aggregate the assets and the asset type non-operated oil and gas interests that you'll hear about. COVID really held us up, if you will, and the interest in oil and gas waned for a bit as prices dipped, et cetera. We identified a team coming out of COVID to execute this strategy with us. And this is a true joint venture, or co-GP, if you will, that we're moving forward on. We had a small close beginning of or end of last year in November. We're very happy about that. That was oil and gas family offices in Texas that believed in our strategy, and that let us demonstrate some of the key tenets of our strategy, which was ability to deploy capital very quickly. And again, as we call capital or raise capital, we can deploy capital within weeks, and we'll talk about why that is. With that, I'm going to turn it over to Samina and let her talk a little bit more about and present and walk through our deck and strategy.
Hi. So in the interest of time, I'm going to share my screen and present the strategy, and happy to handle any questions now or on a follow-up. Can everyone see my screen?
Yes, looks good.
Excellent. Okay, so we have identified an opportunity for low risk, high upside thesis with a very favorable macroeconomic outlook in upstream oil and gas. Greg and I, when we identify an opportunity, the first thing we do is we go find a group that we think is best in class to execute on it, because there's a lot of just basic blocking and tackling that you have to be good at to turn the thesis into an executed deal. So in addition to that, and this we demonstrated that with our first transaction, we have a very efficient way for overseas investors, people in tax haven jurisdictions, if that's of interest, to access the strategy and have a minimal, not zero, but minimal US tax exposure. Now, why do we get to do this? It's a confluence of the recent history and older history. The model of an investor coming in and being able to participate as a non-operating partner in an individual oil well or group of oil wells is something that's been around for 100 years. Now, why is there an opportunity to do this? It's because ESG, in a nutshell. High class, best in class operators are not exiting the space, but they are undercapitalized because of ESG theories. And that creates a sort of a capital vacuum that also creates a high hurdle from the point of view of if you're a potential public company who's a market participant, your cost of equity is extremely high. And so you're willing to bring people on or let other people capitalize on the opportunity because of the comparable the comparative scarcity of capital in this sector. Now, if we think about the upstream investment life cycle, and upstream is just basically you drill a hole in the ground, you get oil and gas out, you sell it. What are the value steps in that life cycle? Well, first of all, you first have to either find the hydrocarbons, or if you have found the hydrocarbons, demonstrate that you know how to get them out of the ground. And the phenomenon that's happened with horizontal drilling and fracking is a lot of knowledge about where hydrocarbons are has been around for a while. But in places like the Permian and other premier U.S. basins, the hydrocarbons were trapped in very tight rock formations. So being able to demonstrate that you know how to get them out was a very useful preliminary step. And really starting around 2011, companies started demonstrating that they could go in and extract the minerals. Now, as they did that, that first bit of the effort was financed on balance sheet. It should have been all equity finance, although it wasn't. And there was a real land grab mentality with a lot of private equity money coming at this. Now, fast forward to today, you've got in the premier U.S. basins, you've got delineated resources, you've got proved reserves, and now we're in a cycle where very high quality operators are engaging in development drilling. So drilling in places where there are a lot of offsets, a lot of you know exactly where what you're doing, and you know exactly what the technology is. Now, development drilling is actually the highest and quickest return of capital in the whole life cycle. If you think about an asset, any asset, whether it's real estate or anything else, as being valued as at the present value of its future cash flows, the minute the drill bit goes in the ground, that implicit discount rate goes down. So this is the steepest value creation uplift in the whole cycle. Also, because of the nature of how oil and gas wells get exploited, all the money comes in on a very front-loaded basis. And the drilled and producing wells are, of course, the cash flow lifeblood of your upstream operator. So they have to keep doing this. Now, if you could just sort of freeze that and say, okay, I've drilled a bunch of wells, now what? If you have a portfolio of wells that have 48 months or more of history, that is a separately monetizable asset. And in fact, that's an asset that has been securitized and will continue to be securitized. So basically where we play is in this middle place where a well's about to be drilled, and we get to step in and be the non-operating partner to a high quality operator. Now, just to remind ourselves what our working interest is, since that's what we're buying, it's a direct investment, a partnership in the drilling and operation of an oil and gas well. So you pay for a pro rata share of drilling and operating, and you get a pro rata share of the profits. Now that asset class has been owned by individual investors all the way to large upstream companies, and we'll talk about why upstream companies might be non-operators to other upstream companies. Just to sort of put a little visual on it, if we think about a flowing barrel, after it's been drilled, when it comes out of the ground, and we're using $100 oil for ease of exposition, who owns that barrel when it comes out? Well, the first person who owns part of the barrel is in this case, the state of Texas. The state owns 8% of that barrel because of severance and ad valorem. Then the minerals owner owns, in this example, 20% of that barrel. Because remember, as an oil and gas operator, I pay Mr. Rancher, Mr. Farmer for the right to extract his minerals. In exchange for that, I give him 20% of the barrel, or 25, or whatever contracted when it comes out of the ground. Then one has to pay for production costs, and then the EBITDA is what the working interest owner owns. You may be familiar with minerals and royalties funds. They invest in this part of the barrel. We invest in this part of the barrel. Now, historically, non-operated working interests came about because of the way these non-traditional fields were developed. So let's say you're back in 2011 or 2000 up to 2014, and you're EOG. and you think you've got technology to drill, but you'd like to diversify risk. Cimarex is next door. So you say, okay, I'll take a 10% stake in your geography, and obviously Cimarex might take a 10% stake in my geography as the OG, and we both feel like we're diversifying risk. Fast forward to today, everybody understands the risk. There is no sense of risk diversification, and you have this mosaic of cross holdings that high quality operators have in each other's fields. Now, you might say, that's great, right? But another phenomenon comes into play, which is that, and by the way, to give you a sense of the scale of this thing, if we're looking at $77 billion of drilling and completion in the next 12 months, pausing about a 10% cross holding. This is all in the established basins. That's a $7 billion a year opportunity to deploy capital. Now, the question is, to remind ourselves, the lion's share of U.S. Hydrocarbon development is going to be in tight oil, i.e. in the premier basins that we're talking about that are accessible to our strategy. So now the question is, why does this happen at all? And the answer is very simply, high quality operators, especially ones that are public companies, have been telling their investors, their capital providers, I'm completely in control of my capital plans. I know exactly what I'm going to spend to drill and develop for the next 5 years. I am a responsible allocator of capital. Now, the one thing that they can't control is their non-op, when the part of the spectrum where they are non-ops, they can't control the other guy's capital drilling. So,
Samina, I think you're one slide off. Apologies for interrupting. You're one slide off in terms of what you're speaking to.
Oh yeah, sorry.
Okay, yeah, okay.
Well, so essentially, I'm a sophisticated operator. I'm also a non-op to the guy next door. The guy next door sends me a notice, and the way these notices work is you get 2 weeks. Usually get like 2 weeks notice. So the operator sends me a notice that says, this is the geography, this is the permit, this is exactly what I'm drilling, this is this 50-line detailed expenditure report. I'm spending $9 million to drill this well. Your share is 900,000. Are you in or are you out? You've got a week to tell me. Now, both I, as the non-op, and the operator know pretty much exactly what the expected production is. And I can qualify it, and then we, as third parties, can qualify and say, well, the drilling IRR on this thing is 60%. Now, in a normal capital market, the non-op would say, woohoo, 60%. Here's my 900,000. Because of the ESG-induced capital constraints, they don't want to do this. So what's their choice? They could say, I go non-consent. The operator says, God bless you, I'll take on your share, and you've got a right to some returns, but only after I make 2 times more money will I send you a check. The other alternative is to go to us and say, here's the opportunity, what will you pay me to step into my shoes? Obviously, they're not going to donate the opportunity at a 60% IRR to us, but we give them a prompt and disciplined bid, and we'll talk about how we come up with that bid, but it's highly specific to the individual well. And then we pay them that money, step into their shoes. The reason they keep coming to us is because they know that we're going to give them a prompt response with correctly priced capital. We then take that interest and integrate it into our investment portfolio. We manage the opportunities as you'd expect. We have appropriate structures. We have asset level transparency should you want to avail yourself of it via our SaaS portfolio management system. So you could go in and see every well that's in your portfolio. And then we have proven service providers that are really world-class. We do have various tax structures that are optimized for onshore and offshore investors. The thing to note about drilling, oil and gas drilling and completion is that the lion's share of the costs generate an immediate tax deduction. The part of the cost that is allocable to intangible, which tends to be 70 to 80% of the cost, is immediately tax deductible, which may be, it can shelter future income or it can be used to shelter other income. Now we maintain, and I have promised Greg not to spend time on this slide, but we maintain a very granular, each one of these lines, I hope you can read them, I don't know if you can, represents a single well opportunity that was presented to us with its, you can imagine it's fairly data intensive. We've evaluated, I think, 700 million of this stuff since we started trying to raise money for this thing. When we bid on a line item, we bid on it based on its highly specific granular, where is it, who's drilling it, what's the expected return, what are all the expected costs, et cetera. So as I alluded to, this is not asymmetrical information with respect to buyers and sellers. We know what it's worth, they know what it's worth. We are luckily in a situation where there's many more opportunities than capital. So we come in and we generate a bid that normalizes the return on that well to 30%, around 30% IRR. So if, as I alluded to, if it's a well that's got a 65% expected IRR, we don't expect to get that for free. We expect to pay the non-op something to just go away. So we put in a lot of analytics, including really stressing the drilling and completion costs. We have some, a sample portfolio that motivated just so we can present to you how these cash flows look. But before I get to it, what I'd like to do is spend a little time showing you what we've already done. So we recently launched a fund, and we decided to take to do a first close just with friends and family money, just to be up and running. So we issued a capital call in October, funded in November. We deployed money in December. And if you look at we can deploy a lot more. It's a question of what we have. So if you look at the first two deals we're under contract. We were able to bid on a 10 well package. As you can see, sometimes you drill one hole and then you have multiple horizontal wells that come out of that top hole. This is the case here. That was a $400,000 drilling and completion. We paid $120,000 to acquire it. The operators, somebody we know very well, Pioneer, recently acquired by Exxon. And the expected IRR from this purchase is over 25%. That we anticipate that they're first going to start producing in the fourth quarter of 2024. Remember, whenever we buy a well, we're not buying a theory. We're buying a well that's already permitted, budgeted, and scheduled. Now, the second one, I'm sorry?
Payback period. Payback.
Full payback in about 30 months from date of capital
Yeah.
deployment, and first cash flows in about 120 days.
Yeah, exactly. Now this
So
one,
we like to refer to this as last look.
Years payback.
Yes, and we refer to this as sort of last look at drill bit. As you just said,
Yeah.
everything's budget
Yeah.
permitted.
Yeah.
We're funding wells and demonstrated
Yeah, and we'll show
performance.
we'll show you a little picture of the cash flows of the theoretical portfolio, but here, these are two deals that we've already bought. Now, this one is my favorite thing, and sometimes this comes up. So this is in Eddy County, New Mexico, in the Delaware Basin. It's 55,000 of drilling completion cost, $8,000 of acquisition cost. Again, this is a fraction of the wells. The wells are actually $12 million wells. This is Mewbourne, top tier Permian Basin operator. Now, what's interesting about this one is that the investor who got the AFE, and operators sometimes do this, the holder who got the AFE, basically, instead of telling you, I'm drilling this next week, they're telling you, in this particular case, I drilled this last year. So actually, these wells have been producing since last June. So we actually have real production data for the first quarter, June to September, and obviously we compare it actually to our theoretical production curve, and it's actually above that. So we're underwriting to a lower curve than what it's actually started at. So in a sense, that really de-risks it because there's even no timing uncertainty. They already drilled it and they're producing. So the IRR on this one is over 40%. Now, that you don't always get this sort of thing. Normally you get the 2 weeks notice that they're about to drill, but this is part of what makes it fun. That it speaks to the quality of the relationships that our land man at Perpetual has. So going back, so if you think about having a whole bunch of these deals, and we have, we also run across larger co-investment opportunities that we can make available to LPs. But anyway, so that's obviously something else that might be of interest. But having said that, if we go back to now going back to a theoretical, okay. I'm sorry?
You got about 5 minutes. Just, I'm gonna.
Okay. So if we go back to the theoretical, so what we did is we put together sort of going through our backlog. So all the things that we could have done, we put together a sample portfolio with the assumption that we'd have to pay up. In fact, built on a bottom up kind of analysis, we assumed that we'd have to pay on average about 33% of the drilling costs to the non-op to go away. And and this is completely realizable based on our this is what a portfolio would be expected to look like. 28% before fees and expenses, 28% IRR with a 30 months return of capital. These are very long tailed. And as we alluded to, these are very once you are in we've got a portfolio of wells that are 48 months or so, that's an asset that trades. So we would liquidate into a lower implicit discount rate, which is part of what we're looking to do. The other thing from a risk point of view is that if we look at this particular portfolio and we look at how the oil and gas are coming in, as you can see, the production is front-end loaded. It's just a characteristic of these types of wells. So when we're underwriting to a part of the futures price curve that is, near in. So we're not betting on what oil is going to do 10 years from now. We're looking at the next 2 years as being the part that we're really. And if we look at sort of our payout metrics, i.e. how do the cash flows look to the investor, we did a little analysis assuming a full taxpayer. And as you can see, what happens is this gray is your tax shelter, because remember 80% of drilling and completion are tax deductible upfront. We assume that we use the tax shelter just to shelter the income from this thing. Obviously, it can be used against other things. And as you can see, you get most of your money back before you before you run through the tax shelter and start having to pay taxes, unfortunately. So basically, I'd submit no timing risk, highly quantifiable, bottom up, granular, well by well portfolio construction, rapid return of capital, and very attractive IRRs. And we have a lot more in this presentation as to how we do our the basic building blocks, which are production forecasting, cost analysis, and then cash flow projections.
And what we put together is something that structurally we think makes a lot more sense than traditional blind pool private equity in the oil and gas space. In particular, we're a 5-year, not a 10-year fund. We partner with one team to go out and build a diversified portfolio for our clients that we think we can liquidate as an entire portfolio 5 years. We have a 1-year extensions, just given market realities at the time we look to liquidate. We've had people come to us and ask us about single transactions, and we think they're not hearing what we're talking about, which is, again, multi-base and multi-operator diversification, providing the tax benefit to these assets to our clients directly, and delivering what we think, given the 2 transactions we've executed, which you brought up, and that big slide that I didn't want to bring up, we've got, $750 million of underwritten transactions in the last years. We've been building this. And again, we closed a small amount of capital to demonstrate that we can start deploying capital as it comes in. And that's key to this strategy. But again, being diversified, not doing quote unquote an oil deal or backing one team with a new play or an existing play. This is about best in class operators, a team that can deploy capital, in-house technology and software that can help us value assets along with our operating partner, and really good legal and administrative structuring, tax structuring.
So as a fund structure, you're gonna buy all of the funds in it, all of the wells in a year or 2? As your 5-year fund?
Exactly. We'll have, let's say, $100 million we would be able to deploy within about a year to 18 months. And so as we call capital, or we're calling capital and spending it immediately, as we just demonstrated, there's a small amount of capital we first close.
And then after 3 or 4 years, you're gonna sell the well?
We're going to sell a portfolio of the package of the entirety of the wells.
Yeah, and as I alluded to, portfolio. I'm sorry, portfolios of existing wells. Once you've got some history under your belt. So once if you look at the production curve, once you're in this part of the production curve where it's just steady, sort of steady eddy, they trade separately. They trade at lower implicit discount rates. And as I said, they also trade into securitization vehicles, which is sort of a newer thing.
You've seen Guggenheim, Morgan Stanley participate in the securitization. Not unlike mortgage-backed securities, if you will. I mean, loosely compare. And that's part of what we're bringing to the table.
Sell that. Is that like 50% of the return or 30% of the return?
So I mean, I can take that, but
I'm sorry, say that again.
On the back end, how much is the sale of the return?
We think that in this market, this type of portfolio would trade to a 15% implicit discount rate. So
what he's asking is, in terms of, we buy wells, we generate and return capital within 30 months, if you will.
Yeah.
What part of the overall return scenario that
before fees, I think we're going to be doing about 28%.
And what he was asking is the sale of the asset, the sale of the portfolio of assets at the end. What part of the disposition, what part of the total return scenario does the disposition create?
Oh, that's an interesting question, and I'd have to I don't want to answer it wrong, but within about 30 months we've had our return of capital. So if you just sort of eyeball this, I'd say probably 30. I mean, obviously this is with taxes, so I shouldn't say this without. But I think if you eyeball this, I think you'll find about 33% of all the dollars that come back are part of that final sale.
Are all the stakes that you're buying from operators who are not operating that stake?
Say that again.
You're buying non-operating stakes, right?
Well, no, we're buying non-operated interests, and the operators that are operating these wells are registered operators in whatever state we're buying these assets.
Yeah.
And who owns the operated interest? Other operators?
Yeah, each one of these wells.
We become part of the owner and the actual operator of the wells.
Are you buying it from the guy who's operating it at that point in time?
Yeah. No. The dynamic is we're buying from the non-ops.
And other big oil companies, the team that assembled the play, landmen, geologists, etc. A wide array of limited partner type owners.
Yeah. So if you look at this example, and I apologize, but so let's say EOG is drilling this well. Conoco owns this little non-op. Conoco says, "What will you pay me to step into my shoes?" And then EOG operates. So in each one of these cases, we qualify the operator, and we only buy from wells that are operated by top tier operators. We will buy from any seller that happens to have anything. It's just that it's much more efficient to talk to these larger, more professional sellers. But if, like,
Underwrite your pricing so you get a 25% return or something.
Absolutely.
We underwrite so you get
We
actually-
underwrite to a return scenario for sure.
Yeah, we underwrite each one of, so every time, so when we bid Conoco for this right, we underwrite to a certain return scenario, and he can say yes or no. But right now, Conoco's implicit analysis is my equity cost of capital in this ridiculous market is 30%. If I can get paid, enough so that return would be 30% to me, then I'll sell it.
Yeah.
Okay, so I know 100% of this stuff because in the 1980s, there was a lot of natural gas drilling in places like Pennsylvania and New York and West Virginia and stuff. And the problem is that the economics were really good when the natural gas prices were high, but as they went down, of course, they didn't become so good. And the runoff was always 30 months or something like that, but it fell down. So
in a
Well,
scenario like that,
that's-
simply speaking, hold on a second, we would not be buying into a downturn, if you will, on gas.
no, but oil, unfortunately, natural gas is,
Yeah, sure.
a problem. So my brother actually has a company that does re-stimulation of wells, and he's
Enhanced oil recovery.
and he's got the Inquitel, the CIA's venture capital firm has it. He actually would have gotten re-stimulation of all the gas wells in the Ukraine, except the war came and
Ooh.
but they wanted too much bribe, they wanted.
Sure.
But
That's the nice thing about doing this
days, other people doing it, but it is a good idea because a lot of these guys go down so low and it's waterless fracking, and if you re-stimulate it, it will actually enhance these returns. Because if they go down quickly, and that's the problem, they go down quickly, and instead of $100 balance, $80 or $60, you do lose your return. So I think that's going to be a good market there, but God knows what the oil prices are because Saudi Arabia is increasing the production and stuff. So there is a variance there.
Of course.
Oh, definitely.
But I do understand this completely, and I can see,
Well, thank you for saying that. I mean, we think that, historically, the oil and gas boom has been fueled by private equity and operators aggregating assets and taking pretty big bets. A lot of them have worked out. We feel like we know where all the oil and gas, a lot of the oil and gas is in the U.S. Producers are focused on focusing their operating dollars, people that are operating our wells in those basins, and there's a half a dozen. I don't think we talked in detail about it today. And we think the best way to play the oil and gas space upstream is really stepping into these non-op shoes, if you will, with incredibly high visibility, very demonstrated returns in the basin by the operators we're becoming partners with, and again, a lot of people will go into a large asset and drill, a lot of wells with one operator. That's not a bad idea, but we think for financial investors, this is absolutely the best way to play the upstream game. And again, diversification across basins and operators. That's our best.
Yeah, and you can never eliminate commodity risk.
Sorry, how large is your relationship with IvyFON? Because they're great.
I mean, that's an interesting question. Our operating partner, Perpetual, has been in this business, and the two gentlemen in particular deployed billions of dollars. And when you start talking about the upstream oil and gas business, who's newborn now versus 5 years ago, what we care about is that they're a very good operating partner, and these guys have relationships at newborn. That's probably how we know who the non-op owners are.
They're amazing people.
Thank you very much.
Thank you.
I hope to follow up with you.
So let me ask another question. Because you're there, who are the two pictures in the background? Are they your relatives or something on the wall?
Oh, my pictures?
Is that your hippie days?
No, those are my daughters.
Oh, okay. That's beards there?
No.
Oh,
What?
they're not beards, it's shades.
I'm not shades. Those are her.
Shades.
Shades?
Oh.
Okay.
That, by the way, that is
Shades,
a small section. That's a small section of Samin's book.
Yeah. That's it. completely different thing. Okay.
Well, this has been fantastic and very educational, I think. So I really appreciate it. Great job, Greg and Samina. Way to go.
Thank you. Thanks very much.